Morning, good afternoon, good evening to you all. We have almost 800 of you listening in to this 16th Tax Talks, still in COVID times. I hope you are all safe, your families are safe, and that you are coping with the current difficult situation. I'm extremely glad to be able, with the team, to brief you on the latest on the international tax agenda. There have been a lot in the press over the past couple of months of exchange of letters, positions, and so the latest has been the G20 finance ministers meeting a few days ago. So before the summer break, summer for our part of the world, we are very happy to give you some details on where we are and where we're heading. We can probably move already to the next slide so that I can introduce the speakers who you know. So I'll be very fast. You know Grace Perez-Navarro, Deputy in the Center for Tax Policy and Administration. You know David Bradbury, who's the man in charge of tax policy and statistics, and he will talk about tax policy statistics, and also he's joined by Åsa Johansson, who works in the other department of the OECD in charge of the economy, ECHO, but as Åsa has worked with us on the impact assessment, so we're glad to have her on these tax talks. And Ben Dickinson will talk about developing countries, and Arim Pros has also joined to talk about Pillar 2. He could also have talked about Pillar 1, but we've decided to share, and Grace will take care of Pillar 1 for today. With these introductions, fast because you know the speakers, let's move on to the topics of the day. I will start by doing an exercise which consists of reading loud the G20 communique. At least I will not say anything controversial, because this has been agreed by the G20 finance ministers at their meeting, their virtual meeting, we could say in Riyadh, but under the Saudi presidency of the G20. I will also quickly brief you on recent developments. We are in a field where things move fast. There will be then the update on tax and digitalization that you're all waiting for. But we are doing many other things, and they are interconnected. So I invite you to pay attention to the presentation David will do on corporate tax statistics, to the work that Ben will report on tax and development. We'll conclude with the presentation so that you can check your agenda of the forthcoming publications, and we'll end up hopefully with a few minutes for Q&As. But let's start now with the next slide on the outcomes of the G20, and I will start the loud reading of the communiqué. Just before reading the communiqué, I think for those of you who have read paragraph 10 of this communiqué, it shows, I think, the political environment of what we're doing, which is not easy. I think we can recognize that, but still reflecting a real will to work together and to find solutions. And in spite of the difficulties that we shouldn't underestimate, we can see that countries stick together in the inclusive framework. There are temptations to move away, to take unilateral measures. There are tensions here and there, but after all, what you can see, and I think that's well reflected in the G20 communiqué, countries want to keep together, to work together, and to seek a consensual solution. So the first sentence is, we will continue our cooperation for a globally fair, sustainable, and modern international tax system. That reflects language already used, which has been used since the launch of the BEPS project, but it shows that tax remains one of the pillars, we like the word pillar, one of the pillars of the G20. They also, that's the second sentence, acknowledge the fact that the COVID pandemic impacted the work on addressing the tax challenges of the digitalization of the economy. It is true that throughout the pandemic, we've worked hard. We were even saying that we worked full steam, which annoyed some people, and we meant by full steam that we wanted to deliver the technical work, the technical background to advance the work, to meet the requirement by the G20. But of course, as shown on that slide, we also worked on COVID to assist governments design the right tax policies to address the outbreak of the virus, but also on the way forward to address the need for recovery and at some point to some form of consolidation, but we don't call for quick consolidation. Next slide will show that on digital, there is some strong messaging, I think. First, the G20 stressed the importance of the inclusive framework work to continue advancing the work on a global and consensus-based solution with, and bold characters are added by us, a report on the blueprints for each pillar to be submitted to their next meeting in October 2020. I think they meet around the 15th of October. So what the G20 finance ministers asked us to do is in October. You remember, we initially planned to have the inclusive framework in July. We held the inclusive framework in July, but just to do an update, and we plan to deliver in October. We are asked to provide the G20 with blueprints, reports, which for each pillar will present a blueprint. What is a blueprint? I'm not an English native speaker, but I think it's much more than the outline of an architecture which was approved in January. So a blueprint will provide the technical details of the features of the unified approach for Pillar 1, of Pillar 2 elements. These should be as close as possible to documents to be agreed by ministers. Because if you read the next sentence, it says, we remain committed to further progress on both pillars to overcome remaining differences, and we reaffirm our commitment to reach a global and consensus-based solution this year. And that's kind of a response to some exchanges which you have seen reflected in the press. These exchanges being about, shall we have an agreement this year? Later, the United States of America and the Secretary for Treasury of the US indicated that reaching an agreement this year may prove difficult. And I think the message was, and still is, that reaching an agreement before the US election may prove difficult. But the fact that we still have the marker of year-end indicates that nobody's postponing, nobody's procrastinating. There is the recognition that the political situation is not easy, that there are important milestones on the calendar, but still an appetite to move together. That's reflected by the US agreeing this communique, by the Europeans as well, who have been very active there, recognizing that they will not move now to propose a fallback position. The communique also reflects of other work because it's not all about digital or digitalization. And there are some fundamental progress which has been made on the tax front. So you can see the recognition of the progress made on exchange of information. And you know that the Secretary General in his report, which I invite you all to read, referred to the numbers from the exchange of information, the automatic exchange of information for the Common Reporting Standard in September 2019. These numbers are quite amazing. More than 100 jurisdictions exchange information automatically, and the information exchange was about 84 million bank accounts, financial account exchange. That's significantly more than the year before, which was about 47 million, with a total value, the bank account balance reflected on these accounts being above 10 trillion euros versus 5 trillion euros, almost 5 trillion euros in 2018. And the G20 does recognize that. That's, I think, a success story of the G20, which started cracking down on bank secrecy, on fiduciary secrecy, to improve transparency throughout the world. And 10 years later, you can see that this has paid off. The G20 also recognized some recent progress because we provided the G20 with a new set of rules, of standards. These standards are not minimum standards, meaning that they are available for countries to implement, but many countries were in demand and asked us to develop this standard, even though some countries might decide not to implement. It's more for the benefit of those interested. And these are new reporting rules for digital platforms for interested countries. We'll go back to that throughout the presentation. Finally, or if we keep moving on, we have the recognition of the BEPS report, which was presented to the G20, and let's not forget about that. It's quite fundamental. Progress on the implementation of the 4 minimum standards, Action 5, Action 6, Action 13, Action 14, but also more implementation of all the other BEPS measures on which there is an update. Now it looks like it's a given, and if you remember well, a few years ago, nobody would have thought that this would be a given. Finally, there is a growing interest by the G20 in international cooperation in the field of development, tax and development. And we are extremely happy to work closely with the IMF, with the World Bank, with the UN throughout the platform for collaboration on tax. And there was a report from the PCT, the Platform for Collaboration on Tax, to support developing countries in strengthening their tax capacity. And that's something we strongly believe in, and we're working hard. I mentioned a couple of times that I'm dreaming of a pillar 3, which would be something dedicated for the developing countries, BEPS for developing countries, something like that. You're all invited to provide ideas and thoughts on how we could move this agenda, and we're working closely with ATAF and other developing countries on that one. Next slide, please. I wanted, beyond the G20 communique, to mention very quickly some other developments. I mentioned Europe, the European Union, and things are moving so fast that there should be a third element on that slide. The first element is the Commission package released on the 15th of July with 3 main elements: 25 measure action plan with detailed measures, but very important one, largely on VAT, but also on corporate income tax, a new DAC 7, a new directive, which draws on the work I referred to, the standards for the platforms and the gig economy. There are some differences, but they are justified by the viewpoint, which is not the same. The EU paying probably more attention to VAT because of the EU environment than we have, and therefore having a scope which is slightly different, broader in that case, but it's no double standard. It's largely aligned, and we're happy with this cooperation with the European Commission. And finally, and very interestingly, a review of progress made in enhancing tax good governance in the European Union, with the view that the Code of Conduct on harmful tax practices should be reviewed so that the general features of EU member states could be examined by their peers. And that goes together with the idea that the EU tax commissioner mentioned, Mr. Gentiloni, which is about using Article 116 of the treaties, of the EU treaties, to try to move to qualified majority. I'm referring to that because it shows that things are moving. And of course, you all looked very carefully at the judgment of the General Court of Justice of the European Union on the Apple case, which, if I summarize it well, says that the EU Commission was right on the principle to look at whether there was a state aid based on the arm's length principle or the AOA, the authorized OECD approach, but sanctions the EU stated conclusions by saying no, there was no state aid, and you have not demonstrated that there was a state aid. The third element that I could add can be found in paragraph 29 and 147 of the EU Council conclusions, which were issued, I think, yesterday evening or overnight. These conclusions refer to a tax on digital companies as a way to increase the own resources of the European Union. And there is also a reference to border carbon adjustment tax. So you can see that the EU leaders also have had this element in their mind. If we move to the next slide, I will be able to then move to Grace for the presentation on the update on the tax and the digitalization project. Grace, over to you.
Thank you, Pascal, and hello, everyone. I know a lot of people are very interested in what's been happening on Pillar 1, especially given all the fireworks over the last few months about whether we are suspended or not. I think we've moved ahead to the state of play, but anyway, on the Pillar 1, what you should be seeing is the basic building blocks of the Pillar 1, the so-called unified approach. And just to remind everybody of what the different components are, the main components anyway, Amount A is the new taxing right over residual profits that is to be determined in a formulaic manner at an M&E group or segment level. And this is the primary response to the tax challenges posed by the digitalization of the economy. And you can see below the Amount A that there are a number of key elements that need to be determined and that will form the basis of the blueprint that we are developing. There's also Amount B, which is not directly related to the digital issues, but was included in the package as an attempt to try and simplify some aspects of transfer pricing and to reduce the administrative burden and to increase tax certainty. And then we have, speaking of tax certainty, what was called Amount C, but really is designed to ensure tax certainty. And so if we now move to the next slide for the status of the work on Amount A, here you can see where we are. We've been making very good progress despite the pandemic, despite the fireworks we've had over whether we're at an impasse or not, whether we're narrowing the scope or delaying, etc. And so we are making very good progress on the this work. We have done a lot of work on things such as the taxable base, where we're looking to financial accounts to determine the tax base. And a lot of work has progressed on using consolidated financial accounts, using either IFRS or convergent accounting standards, including US GAAP, and looking at how this can be computed at a profit before tax level. So that is work that is well underway and helping us very much in advance this work. We are also looking to see what limited adjustments would need to be made to the profit before tax figure. And we've been leveraging a lot of the good work that Achim and his team have done on Pillar 2 to try and move this forward. We've also been looking at issues like segmentation. We know that's on a lot of people's minds. There are a number of areas of convergence on this issue. We're working to ensure that we can also develop simplification options in this area to try to limit how much segmentation can be done. There's still some issues there about whether regional segmentation is needed and the computation of the tax base there, but we continue to move forward. Everyone's very interested on the issue of recognition of losses. Losses will be recognized. We're sorting out how to deal with that. There's a lot of agreement already on using an earn-out mechanism at segment level. Very broad support for computing these rules, applying the same types of computational rules to both the profits and losses. And there are also some areas where we haven't yet reached agreement, but that is what we will be doing in the coming weeks, looking at how to treat profit shortfalls, how to treat pre-regime losses, and how far can losses be carried forward. So those are some of the issues. The big political questions are the scope and the quantum. So those decisions will come much later. Now, if we look at the next slide, amount B and tax certainty. On amount B, there is a lot of support for this. We are moving ahead. This, unlike amount A, remains tied to the arm's length principle. As I said, it is a simplification. And so we are looking to further develop that, and you'll see that in the blueprint. There is some debate about whether we have a broad scope or a more narrow scope and the level of tax certainty. So those are issues that we will be looking at more carefully. And then on tax certainty, here we've also done a lot of good work to try and come up with solutions that will provide early certainty in the form of dispute prevention. And this is especially important in the context of amount A, where we're using a formulaic approach across an entire multinational group. So we are developing a two-phase process using panels with an initial determination process that if the panel is not able to agree, then we'll have another panel that will be a decision-making panel. So that's the kind of thing we are looking at to try to ensure that there will be finality and a binding decision. So we're also looking at the whole issue of dispute prevention and resolution in the context of amounts B and C. We have made good progress on both of those. There are some open issues in terms of the scope of amount C. So I think I'll leave it there, and we'll surely come back to the whole issue of Pillar 1 when we get to the Q&As. But for now, I will turn it over to Achim,
who has unmuted himself but does not show his beautiful face because his connection is not sufficiently good. But I will give you a brief update on Pillar 2 and where we are. We're making this simple, as Grace has mentioned. We very much focus on simplification, so I've simplified my slideshow and reduced it to one slide. So this is the overview that you have all seen for those that tune in on a regular basis to these updates. So I'm just going to touch on a couple of highlights. I'm not going to take you through all of these aspects. You've seen this, you've heard me talk about these different features. If you look at the income inclusion rule and the undertax payment rule here on the left part, I think, as I was able to say at the last time and still continues to be the case, I think we are extremely advanced and making very good progress on a number of those blocks that you see here. And one of the reasons that I'm talking and not some of the other people are talking is because Working Party 11 that is working on these issues and Working Party 1 are in session as we speak. I think the tax base, as I said, is largely developed, and thank you all for the input, in particular through the consultation in December, but also more recently. It has allowed us to build out the tax base. I think the same is true for covered taxes. I think we've worked on blending aspects, timing differences. I think there's outstanding technical questions around which mechanism to use, but there's broad consensus that timing differences in and by itself should not get you into a potential application of the min tax. So the discussion is much more focused on what is the best mechanism that combines efficiency with something that can be operated relatively easily at low compliance cost, but is targeted, noting, of course, that we're operating on the basis of financial accounts, and so there's questions here. I think there is a number of clarifications on sectoral carve-outs, I think, where we've had good input from many of you, including investment entities and others, and we've had discussions with industry. And I think there is a recognition that if there is a specific policy intent that we find in many, if not all countries around the world, that particular collective investment vehicles shouldn't be subject to an additional level of taxation, that principle should carry through also within the context of a Pillar 2. I think on more substance carve-outs, we're having discussions in the working party on what this might look like for tangible assets, for payroll, for other features, how they would be calculated, what they would be. And I think there is a broad recognition amongst those that would like to operate without any carve-outs and those that are insistent on carve-outs, that we will be developing something in that space, and that is what we're doing right now. Simplification is a very important topic. I think at an earlier webcast, Tax Talks, I've walked you through the simplifications that people are considering in the working party. So given the time, I'm not going to go through each and every one of those simplifications. I think there's broad acceptance. There is a recognition that we would need to avoid situation where taxpayers would be forced to go through a complicated compliance process only to find out what essentially they already knew, i.e. that with respect to a particular jurisdiction, with respect to this situation, there isn't really an inclusion under the income inclusion rule or the undertax payment rule. So the idea is to identify the situations where on a risk basis, the indicators on an ex ante basis as such that it wouldn't really justify having to go the whole 9 yards and calculate the effective tax rate based on agreed base and rate. And we are trying to identify what these situations are. Importantly also, I think there is a recognition in the working party that what tax administrations might consider simplifications may not be simplifications to businesses and those affected. So we will not finalize the simplifications without a discussion and engagement with business, which we've had, but more of which we will need, in particular in this area, so that the sorts of simplifications that we are having in mind, we meaning the inclusive framework, are sorts of simplifications that achieve the tax policy objective, but do it in a way that it has reasonable and proportionate compliance costs. These simplifications could be potentially options for taxpayers. Some taxpayers might find it easier to operate without them. Remember that you're either in or you're out, and if you're above, you might not need simplifications because they may make no difference. So we'll go through those questions, and it is noted that it probably wouldn't make sense without a more detailed engagement with business to finalize on particular simplifications, just to make sure that once we have them in place, the pillar is actually simpler rather than maybe more complicated. We're making also good progress, and I'm running through in my remaining minutes, we're making good progress on the undertax payment rule, understood as a backstop to the income inclusion rule, assuming also that then the income inclusion rule would be the priority rule, largely following a top-down approach. Many of these things I think I have mentioned, and we're in discussions on the particular allocation keys. Importantly, the undertax payment rule would follow essentially all the same steps and hence wouldn't bring any additional compliance cost as the income inclusion rule, other than the allocation out and the mechanism that would be followed to achieve that. The switchover rule, very briefly, I think that's more of a side issue for particular countries that have committed in their treaties to use the exemption method. Subject to tax rule may be a word that is a very important rule. We've heard this from various stakeholders, civil society, but also many developing countries. So we're trying to work out now what the particular subject to tax rule could be, what scope it has, whether it operates off a nominal rate, how it would function, so that it is simple to apply, it is effective, and that the pillar as a whole ensures that we have a fair, I think it's not an allocation question here, but a fair revenue expectation share, I think, so that there is an equal benefit to the pillar in ways that we can do this, as I said, with the appropriate simplification. So we also try to make this as easy as we can. So more work to be done, but I think broadly, we are in a good way with respect to the pillar. Give it back to Pascal, I think.
Thank you, Arim. Actually, you're giving it back to Åsa, who will make a brief on the latest related to the economic analysis and the impact assessment. Åsa.
Thank you, Pascal, and hello, everybody. So I will just give a short recap of an overview of the high-level insights from the economic impact assessment. So please, yes, the right slides. So the impact assessment is done to inform the discussions at the inclusive framework. And to do so, we have set up a flexible analytical framework so we can test different design and parameters of Pillar 1 and Pillar 2. And the framework we're using to do this cover more than 200 jurisdictions, meaning all members of the inclusive framework. And we have been combining the best available firm level data and also macro data. Still, we know that data has some limitations, and that's notably the timeliness of the data. And we've also done some assumptions in order to do our analysis. So it's important to stress that these assumptions that we've been doing in economic impact assessment is supposed to be seen as illustrative and not to prejudge any decisions that are being taken by the inclusive framework. So having said that, the analysis that we've done shows that the overall impact on global tax revenues would be significant due to a combined effect of Pillar 1 and 2. So more specifically, our analysis shows that the overall estimated global net revenue gain could be up to around 4% of global corporate income tax revenues, or this is about $100 billion annually, and the precise amount depends on reform design and parameters. And specifically, Pillar 1 will involve a significant change to the way taxing rights are allocated across jurisdictions, which is the intention of the reform, but it would also lead to a modest gain in revenues in most jurisdictions. And the reason for this is that the taxing rights shift from low tax to higher tax jurisdictions. Pillar 2 would yield a significant increase in corporate income tax revenue globally, and the precise magnitude depends on the final design and rate of Pillar 2. We've also done some further work looking at detailed data, and this work shows that multinationals that are active in digital-oriented and intangible-intensive sectors could be significantly impacted by both pillars. It is important to keep in mind that these estimates that we've done, they don't take into account the implications of the COVID-19 crisis. And the reason for that is that it is difficult to quantify the impact of the crisis as it's still ongoing. We've done some preliminary assessment of the impact of the crisis, and there may be some negative impact on overall revenue gains, at least in the short and the medium term, as firms' profits are currently being reduced to the slowdown in activities that we see. In the longer term, the effect of the crisis on revenue estimates is uncertain, and this is because it depends on the shape and the speed of the economic recovery, but it also depends on structural changes that may occur in the economy due to COVID-19. For example, COVID-19 may intensify the trend that we've been seeing towards digitalisation, and that would in turn increase the importance of automated digital services in Pillar 1. So next slide, please. So the proposals would also introduce significant changes to international tax rules, and that could potentially affect global investment. And we have been doing some work at the OECD on the impact on firms' investment, and this work suggests that the proposals have small effects on firms' investment costs. On the other hand, the proposals have the potential to improve tax certainty, and this could in turn support investment in global growth. So on balance, the proposals are likely to have a modest effect on global investment. And the reason for this is that the work we've done, some modeling suggests that the effect on effective corporate income taxes from the reforms is generally modest. And the reason for that is that many firms will be unaffected by the proposals. And that is because the proposals target firms with high levels of profitability. And these are also often the firms whose investment decisions are found to be less sensitive to taxation in the first place. Additionally, the both pillars could reduce the dispersion of effective tax rate, and in this way reduce profit shifting incentives of firms. And that could have implications for tax revenues and also economic efficiency, as it can lead the firms to locate investment more based on market factors rather than tax factors. And the result of the impact of the proposals on investment and growth, they should be compared to a counterfactual scenario. And it's important to keep in mind that this counterfactual scenario are unlikely looks like the current situations. Instead, it's likely that a failure to achieve a consensus-based solution could lead to more pressure for more unilateral measures, tax uncertainty, and trade disputes. And tax and trade disputes, they will have adverse effect on the global economy through several channels by reducing trade, investment, and it would also affect households' income, for example, via reduction in wages and higher prices of the goods. And this is important, especially in the current context of recovery from the COVID-19 crisis, as these type of tax and trade disputes could add to the negative effect of the COVID crisis and hinder a recovery. So that's a quick update on the work that we're doing on the impact assessment. And I hand back to Pascal now. Thank you.
Thank you very much, Åsa. Let's go quickly through the next steps so that we don't run out of time and have some time left for the Q&As. Next steps. Well, the next steps are actually different milestones. The first one being the inclusive framework meeting, 8 and 9 of October. And as I indicated, we hope to be able to present to the inclusive framework blueprints for adoption. Now, the question is at the level of the inclusive framework members, will it be adoption without prejudice? Will it be adoption subject to further political decisions? Will it be blueprints which will solve all possible differences? I think we need to be realistic, and as much as we welcome the G20 telling us that they hope to have an agreement by year-end and they aim to have an agreement by year-end, we have to recognize that there are a number of pending issues. One of them being the scope. I think the scoping issue is probably one of the most difficult. A number of countries, or at least the US and China and probably some other countries, think that we should not have a solution ring-fenced to the digital businesses. And that's clearly a red line. The difficulty being that the unified approach which proposed to add consumer-facing businesses, and that almost all countries agreed, triggered some backlash, and the letter by Secretary Mnuchin, 3rd of December 2019, basically says, well, it's going to prove difficult to move into that direction, and maybe a safe harbor approach, which solves the scope issue by letting companies decide whether they're on scope or not, I would say, is still pending, and we'll see whether it can be solved before the US election or not. So that's a big question mark. But all the other issues are being addressed, are being developed, and all the 11 building blocks of Pillar 1, the different chapters on Pillar 2 will be ready as a blueprint for the inclusive framework, so that we can see that we have elements ready for quicker political decisions, because at some point the scope issue is a political decision. It's not a technical issue. There are many technical consequences that we'll have to handle, but fundamentally it's about a political call. The inclusive framework will report to the G20 finance ministers, who will be meeting in Washington virtually, actually, on the 15th and 16th of October. And this will then go to the leaders on the 21st and 22nd of November with, by the way, President Trump, as the US administration will stay as is till early January, whatever the outcome of the election is. And then the 1st of December, the Italians take over the G20 presidency. So these are our milestones, and you can guess that between now and then, between now and October, there's a lot of work to do to finalize all the different chapters of the blueprints, knowing that the chapters, as indicated by Grace and Arim earlier, have been looked at by the working parties. And all these shows the progress made during COVID crisis between January and now in terms of moving from an outline of an architecture to blueprints. On that note, I will stop and turn to David, I think, so that he can brief you on the corporate income tax statistics, which are linked to what we're talking about. Oh, sorry, no, to Grace. We'll move to corporate income tax statistics later. You saw that in the G20 communiqué, there is a reference to the model rules. I think this is an important development that Grace will develop for you. Grace.
Thank you, Pascal. If we can just move to the next slide, where we define the sharing and gig economy. I thought that was important because someone once thought that the gig economy had to do with gigabytes. So it does not. It has to do with sharing either goods and services through digital platforms, or gig is basically independent workers, such as you see through Uber, Lyft, other similar services, food delivery services, etc. So that is what this report is designed to address. And this was something that was actually included in the interim report that we did on the tax challenges of digitalization as one of the other issues that should be dealt with. So we have produced a report. What does it cover? If we can go to the next slide. Oh, before we get to what it covers, we have, I wanted to show you this because this explains really why this is so important. If you look at these figures, and this chart was made before COVID, but we still expect to see rapid growth in this area, you can see that the growth is expected to be dramatic in just a very short period of time, from 5% in 2013 to 50% of the rental space. So that shows that this is very significant. Now, if we go to the next slide to the scope of the model rules, you can see that we're covering basically the two main areas where this is an issue, and it's the rental of immovable property and then personal services. And you have listed there the different types of personal services. So this is what is being covered by these model platform rules. And in the next slide, you can see how the exchange is supposed to work. So the platforms will be gathering the information. They will be sending the information to the tax administration where they are located. That tax administration will share the information with the other jurisdiction where the seller is located. And this information can be used by both jurisdictions to pre-fill tax returns. Obviously, this is not required. Different tax administrations have different capacity for doing that, but this is certainly an important aspect of this whole process, because that will help to facilitate compliance by taxpayers and also streamline the operations of the tax administration. So that is how the exchange works, not too different from other types of exchange of information. And then if we go into the next slide, we can look at why this is so useful to different stakeholders. First, if you think about the tax administration, well, this is going to help move tax administrations into the 21st century by helping to foster what we call compliance by design, by building in elements of compliance in the design of the system. And here, we're building it in as the number of independent workers grows, so that this will, as you saw from that earlier slide, this will already be established by the time we get to 50% of global revenues being made up of this type of activity. Then if we look to the benefits for the market jurisdiction, we see that this will enhance the access to data from platforms from around the globe. This is going to ensure timely access to quality data. help the enforceability of reporting by platforms, and ensure equal taxation for users of the digital economy. Then in terms of the host jurisdiction of the platform, this will minimize ad hoc requests from its treaty partners for information from these platforms. It will provide a clear legal basis and structure for exchanging platform data with treaty partners. And it can also attract platforms to set up their bases in those jurisdictions that have adopted the model platform rules. Now, this is also beneficial for business, and we did work a lot with business on this. It's beneficial because this will shield platforms from a proliferation of different unilateral measures, all aimed at getting the same type of information from platforms. So this will facilitate having a standardized reporting regime and hopefully reduce compliance burdens. And then for the taxpayers who are using these platforms to offer their services, this will facilitate easy compliance. And as I mentioned, the pre-filled returns is one aspect of that. It also, and going back to the tax administrations, one important feature of this is that this is going to help bring a lot of the informal cash economy into the radar of tax administrations. So a lot of these activities, which used to be done outside of platforms, are now going to come into the tax administration's radar by being reported by the platforms. So those are just some of the benefits that will be achieved through this system. The other thing I should mention is that these model rules are model rules, and so they're not obligatory, but obviously the more countries that use these model rules, the more standardization we will have across the globe, the easier it will be to have this exchange of information, and it will reduce the compliance burdens. So with that, I will now turn it over to David.
Thanks very much, Grace, and it's great to connect with you all, regardless of where you are across the globe. It's my pleasure to be able to update you on our recent launch of the Corporate Tax Statistics database. And in particular, we would like to highlight the country-by-country reporting data. If we could just move to the next slide. And the background here, of course, is that during the BEPS project under Action 11, one of the key recommendations and key findings was that there was insufficient data to support the ongoing analysis of BEPS and multinational enterprises. And coming out of that was the recommendation that we publish on an ongoing basis relevant information about corporations and multinationals. And last year we launched the Corporate Tax Statistics, and this year we have just 2 weeks ago launched the second edition. Now this slide shows you the various elements of the database. I won't go through them in detail, but you can see wide country coverage. You can also see the bottom 3 items. These are the new items that are new additions to the database, and one of them in particular has been much anticipated. That's the anonymised and aggregated country-by-country report data. We also have some valuable information on CFC rules and interest limitation rules. If we can turn to the next slide, I'd like to tell you a little about the country-by-country reports. And this, as I said, has been much anticipated. Under Action 13, CbCR were established as part of a high-level risk assessment tool for tax administrations, but they also provide an important new source of statistical data, and that was the work we've been doing under Action 11. Now, of course, there are data limitations, and clearly the data itself is anonymised and aggregated, and that's in order to preserve the confidentiality of the data. We don't see the underlying returns, the underlying reports, but working with member jurisdictions with a common template, they have been able to provide to us that underlying data. Now, in terms of those data limitations, there is a detailed disclaimer for those of you that are interested in these matters, and the link is there on the slide. Of course, we've already taken some actions to try and improve the quality of the data. Some of these things, of course, will take some time to take effect. Now, whilst this is only a single year of data, it's always difficult to draw too many conclusions from 1 year of data. We think that there are some initial insights on BEPS. However, we should be cautious about drawing those conclusions. Just before we turn to the next slide, the figure there demonstrates to you the number of jurisdictions involved. 26 jurisdictions, which accounts for 74% coverage rate of the CbCRs available for sharing. And they cover more than 4,000 multinational enterprise groups operating across 100 jurisdictions. If we move to the next slide now. What are some of the key insights that we can draw? Well, we do see evidence or suggestive evidence that there is a misalignment between the location where profits are reported and the location where economic activities occur. And I'll show you a graph on that shortly. But we also see that, for example, revenues per employee tend to be higher where statutory CIT rates are 0. And we also find the same thing in investment hubs. We also see that on average, the share of related party revenues in total revenues is higher in investment hubs. Now, of course, in both of these last 2 points, there may well be a range of commercial reasons that might justify why this is the case. But in both instances, these are also high-level risk assessment indicators when it comes to BEPS. And of course, there is some valuable information provided in the CbCR on business activity across jurisdictions, and we have a graph to show you on that as well. If we can turn to the next slide, this slide shows you across 3 jurisdiction groups: high income on the left, middle and low income in the middle, and investment hubs on the right. What's interesting is that whilst there are large shares of tangible assets and employees, underlying economic activities, if you like, present in the high income and middle and low income graphs, when you look at investment hubs, there is a relatively large share of profits and related party revenues compared to a relatively low share of tangible assets and employees. Now, that, of course, may well be an indicator of BEPS. It's difficult to draw strong conclusions, but that of itself does show that there is something of a misalignment between where profits are located and where economic activities are occurring. And one more graph to share with you is the next slide. And in this slide, we see some interesting information about the composition of business activity across different jurisdiction groups. So once again, we've broken this down into high income jurisdictions, middle and low income jurisdictions is the middle bar, and then the bottom one is investment hubs. And what we see there is that there are different types of activities that are more prevalent in these jurisdiction groups. So for example, in high and low and middle income jurisdictions, we see a higher share of employees we see a higher share of companies that are engaged in sales or manufacturing or services. And then in the bottom bar, we see for investment hubs, a very high degree of ownership of holding companies. So holding shares and other equity instruments. Now, this concentration of holding companies can tell us a number of things. At one level, it is also another high level risk assessment factor when it comes to BEPS. But there may well be other commercial reasons for that as well. So once again, the data that's provided, it does provide us with some interesting insights, but some caution has to be addressed to this data because it is a single year and there are a range of limitations that we wish to highlight. Now, I'll leave it there and I'll now hand over to Ben Dickinson, who will provide a report on tax and development.
Hi, Ben. As discussed, we just had a slight issue with the PowerPoint, so I will be sharing.
Okay, thank you very much, and good morning, good afternoon, good evening to wherever you are. We have a very busy tax and development agenda, and I'm just going to, next slide please. The first is to alert you to a report that we produced on the 9th of July, which is available on our website, which tracks the progress we're making on all of our work with developing countries on tax matters. And the story goes something like this, that the participation and inclusion of developing countries in the BEPS work and on exchange of information through the Global Forum and in the inclusive framework is triggering demand from developing countries for everything that the OECD does on tax. And our report reports on the full year of 2019, where we made progress on all of the areas of taxation that we work on. So that includes all aspects of tax policy, on revenue statistics, on health, environment, tax and crime. So I'd encourage you to look at the progress we're making on all aspects. We will communicate further in September when the UN has much development activity to report, and we'll be working with them to report on some of our work with developing countries there. The report concludes that in an era of COVID, that there are further calls for developing countries for more on tax matters, not just from the OECD, but from others too. And as Pascal mentioned, the time is right to take a clear look at what the benefits are of the international tax rules for developing countries, and also to look at some of the tax policy and tax administration issues that are facing developing countries as fiscal space tightens. Next slide, please. Secondly, to alert you to progress we're making on Tax Inspectors Without Borders, which is our special learning by doing audit work, where we work on real cases, and you can see the significant gains in terms of revenues achieved, $532 million to date, with more on the way because there's a much greater number of assessments due. We're expanding rapidly, and we're using more and more experts from different ranges of countries, including South-South cooperation. So we're not just using expertise from the advanced countries, we're using experts from wherever we can find them. We've expanded into using Tax Inspectors Without Borders to look at tax and crime issues, and there's some pilot work underway. Perhaps most importantly, our board met recently and gave us the instruction to extend the Tax Inspectors Without Borders model to new areas, so the automatic exchange of information, data use, to look at how the model might apply to tax treaties and to joint audits. And finally, on Tax Inspectors Without Borders, just to make the point that we are very much open for business, and we're working hard with administrations in the remote working era to make sure that information is shared securely using all sorts of different methods for confidential sharing. Next slide, please. And finally, a word about the platform for collaboration on tax. Pascal mentioned at the outset that the G20 received a report. Let me just set out a couple of points as to what's in there. We've got a new website where the 4 partners working together have set out exactly how all their technical cooperation activities fit together. So you can see in one place where all of our activities are, for the sake of coherence and to avoid duplication. In terms of the technical work, we've done a range of international tax toolkits. The latest has just been released on the offshore indirect transfers issue, an important capital gains issue facing developing countries. And finally, we report on what we're calling the medium-term revenue strategy process, which is a planning mechanism which many developing countries are adopting. It's very important for the OECD because it's a way of setting out how international tax matters fit in with all sorts of other priorities and issues of sequencing and so on. So that's a quick update for today on tax and development, and I'll hand back to Pascal, I think.
Thank you very much, Ben. Very quickly on the forthcoming, next slide, please. What's next? You will have the revenue statistics in Asian and Pacific countries coming out in the coming days. Breaking news there, for the first time, we will have the data from China. So we've been able, and that's been a long work with the Chinese authorities, but we've been able to come up with tax statistics for China, which will be incorporated in the overall database, which covers more than 100 countries, and in this publication. There will be a PCT, Platform for Collaboration on Tax, webinar also in July. The BEPS Section 14 peer review reports will be issued together with a toolkit for the Convention on Mutual Assistance in Tax Matters. We're back to transparency here. And also another report on tax administration, assisting wider government COVID-19 support. And I'm not sure it's yet public, so be aware that there is a change of chair in the coming days in the Forum on Tax Administration. So in case it was not public, I will make it public, some breaking news at the end. For those who have not left, 100 people have left after digital, not nice of you. So you will miss the big information that Hans Christian Holte has has been appointed to another job in Norway, and therefore steps down the 1st of August from the FTA. And Bob Hamilton, the tax commissioner in charge of the Canadian Revenue Authority, CRA, has been elected chair of the FTA. We are late for Q&As, but we'll take a couple of them. The first one, which I can see on the thread of Q&As, is about the impact assessment. There is a big frustration of, okay, you also have very nice presentation, but you give broad figures by broad, not even broad categories, overall global. When can we see detailed data? My response would be, we would be happy to share the data and the granular data, but the member countries are extremely cautious there. So Osa and David, when will we have some more granular data available? What's the goal?
Thanks, Pascal. We're certainly working towards publishing the impact assessment in the second half of the year. In terms of the granularity of that data, we're still working with the members, but at the very least, we will be providing results at a jurisdiction group level, and we'll try and disaggregate that to the greatest extent that we can. But we're looking at publishing in the second half of the year after the summer break.
Thank you, David and Osa, and be aware that the OECD Secretariat is very much in favor of being as transparent as possible, providing as granular data as possible. This is economic work which will benefit from comments and from contradictions so that we can improve it. The other question we have is, will there be public consultations on the blueprints? And there is no easy answer because we don't exactly know what type of agreement will be reached in October. So we just read the instruction we received from the G20 to say we are seeking an agreement by year end, and we must provide them with blueprints in October. So what's going to happen? It's hard to say, but I think we can probably reassure you that whatever is agreed in October, however advanced the blueprints are, there will be room for implementation rules to be developed. There will be a room for comments. And I think it's fair to say that, again, whatever the level of the agreement is on each pillar, and whether they are linked together, bundled or not, which is a political decision to be taken by members, the blueprints will definitely, one way or another, be made public on the one hand, and two, will call for comments on a number of aspects. So no big fear here that everything will be decided in black box and then new regime will start, will kick off on the 1st of January 21. Not the case for none of the pillars. So there will be room. Please, for the implementation may allow some fine-tuning here and there. And we know that some of the key questions have not been solved, like the scope issue. So I'm pretty sure that there will be room. Don't be frustrated. You will have time for commenting, for inputting. We are not doing that in a black box. We are consulting, we are interacting with the stakeholders. The BIAC and TUAC spoke at the last inclusive framework meeting. So there is this interaction also with the members, because I know you are talking to the members separately. So no big worry there. The big worry for the time being is for the team to be able to write all these down, to consult with the working parties over the summer period, and which usually is vacation time. Unfortunately, for the brave team of CTP, is not really vacation, but pretty hard work to meet the political deadlines on something. And David and Osa made the point, which could degenerate into trade wars and harming further the economy, which clearly doesn't need that. On a positive note, we look forward to seeing you again, or we look forward to you seeing us, because it's not really reciprocal because of Zoom, but soon. I suggest that sometime in September, we can get back to you to brief you on the state of play, and definitely in October you will hear from us. I wish you to keep safe wherever you are in the world. Unfortunately, COVID-19 is not over, and different regions of the world are more or less hit. So our thoughts to those of you going through difficult times, and for the others, I hope you can take some rest during your winter break if you're in the south, or your summer break if you're in the north. And let's keep engaged. Let me thank the team that you have seen on the screen, the team that you have not seen on the screen, Carrie, Eloise, Hazel, Brigitte. And on that note, enjoy your summer. Be patient. In a few weeks, you will see what we are coming up with. And see you. Bye-bye.